Happy Friday to everybody. We're coming to you live here at the Berry Financial Group building. Reid, Mathews, and Korbin, Causey. We're praying for everybody during these very difficult times. We want to give you some value with talking a little bit about mortgage rates. Should you refinance? That's why we've got our specialists with Korbin, Causey. And then also talking about Delaware Statutory Trusts, one of the greatest options for avoiding capital gains on real estate that we're definitely excited to share with you today. So Korbin, let's jump in here. What are you seeing with mortgages and the rate volatility that we have going on?
Yeah, Reid, thanks for having me again here today at your office. We appreciate, all the business we do with you guys. But basically, just to touch on mortgages, the volatility of the rates in our market are something that's, the biggest question that I get day to day from financial advisors, from appraisers, from real estate agents, from clients. And so just to touch on that, conventional rates right now are not technically backed by the government. They're not government loans. So conventional rates are still phenomenal, still the perfect time to refinance a conventional mortgage. And really they're as sharp as they've ever been. Conventional rates are historically low. So it's something to definitely touch on if you're looking to have a conventional loan. Great time to buy, great time to refinance if you have a conventional loan. From a government standpoint, FHA, VA, USDA loans are all government-backed loans. They're called government loans, and so they're basically sold on the secondary market and funded by the government. Well, there's not really a market right now for secondary purchase, high-risk loans. So that's caused a lot of carriers and investors such as PennyMac and other FHA, VA, and USDA investors to not want to buy these mortgage-backed securities on the secondary market. We guys do, and so really that's caused FHA, VA, and USDA loans to be a little more complicated right now. Requirements as far as credit scores have increased a little bit, which is obviously causing clients who may have been able to qualify 3 months ago to now have a little bit more of a struggle qualifying, and the rates may have either points attached to them or possibly be a little bit higher interest rate on a government-backed loan. So that's really the biggest thing on the interest rate standpoint of it. But it's still a great time to buy. Still, the market is still phenomenal. It's actually shifting probably a little bit more towards the buyer's market now because of some sellers wanting to get rid of their property quicker during the, maybe create a cash flow of a secondary home or an investment property that they don't want to hold on to any longer. So it's a great time to be purchasing and an amazing time to be refinancing.
What do you see with, of course, all these unemployment ratios and going skyrocketing with people losing their jobs and things? What is your opinion on the next 6 to 12 months? What's going to happen with these mortgage rates?
Personally, I think we're going to stay really low on the conventional side. Conventional rates right now are going to stay low. I think the economy is going to come back. Personally, we talked about this from my personal standpoint. I think the economy is going to come back booming for real estate. Whether that gets through, especially down here in Myrtle Beach, we're tourist attraction. We're a secondary home market. We're an investment market. I think real estate is going to be, just take off once all this is over, because people are going to want to travel to the beach. They're going to realize how much they appreciated that beach house that they couldn't get to, how much they appreciated being on the waterway. And I think that's going to make rates stay low conventionally. I do think it will take a while for government lending to recover, just because the government has pushed so much money into making sure that the mortgage arena doesn't fail them.
Awesome, man. Thank you for that. And then being a wealth counselor here at Berry Financial Group, all things money we try to help people with. So specifically with refinancing, I know you've saved numerous of our clients on money on that. So what are the different refinance options and when does it really make sense?
Yeah, so to touch on refi options, there are 3 types of refinances that you can do that, are key in my opinion. You have a client who may want to, refinance to do a rate term refinance, which simply just means, you, for instance, Reid, you bought a beautiful home, you have it at, let's just say 4.5%. Okay. And now rates are, 3.5%. So if I can save you a whole percent over a 30-year term, then figuratively $600,000-$700,000 house, a whole percent, you're talking about, you're going to save $250-$300 a month. And so, and more importantly, think $300. If I save you $300 a month, if I told you right now, Reid, I can give you $300 a month. That's $3,600 a year. Yeah. Over 30 years, we're talking near $100,000. So, if you're thinking about you're going to save $100,000, on a $500,000 home over a 30-year time period, what could you do with that $100,000? That's really the key of a rate term refi is to either get a lower rate or take a 30-year mortgage. Say you've come into a large pay raise and now you want to pay in years, maybe you drop that 30-year to a 15-year. And you're not taking any money, particularly to streamline from one interest rate to a better interest rate because it financially makes sense for you on your monthly payment. That's our first option. The second option, like I was telling you earlier, a lot of people don't use this option. It makes a lot of sense for anyone who doesn't like having a lot of monthly payments. So say, usually for example, again, Reid, say you have a $500,000 house and you only owe $200,000 on it.
Okay.
We have what's called a debt consolidation refi. So say you have a car payment, your wife's got a car payment, you got a boat payment, and you got 2 credit cards, and you got a house payment. All that totals up to $300,000. You owe $200,000 on your home. Your house is worth $500,000. Your monthly obligation currently, between your boat, car, house, and credit card is $7,000.
Okay. You
want to create cash flow for your incoming money during this tough time and lower your monthly obligation. If you take that debt consolidation loan, refinance your house to a lower interest rate, more than likely still, and tie all those obligations up into that refinance, then you've lowered your monthly obligations from $7,000 to maybe $2,500, which you created a stream of $4,500 a month to either one, invest with you guys, put somewhere else in an annuity, or just know that you have cash sitting aside to create cash flow if you're looking to maybe retire soon or want to build, wealth within your portfolio.
Yeah, that sounds incredible. The debt consolidation, what I like about it too is
one payment.
Exactly. I mean, a lot of what we see with 3,000 clients and the average age client being 65, most people, especially me too, at this age as well, I want my life simple. So to have save money, debt consolidation, one payment makes a lot of sense to me.
Yeah, and a lot of people they're reluctant to it because of the fact they say, well, I don't want to pay for my car for 30 years. Okay, let's say your car is at 6% interest rate right now, and you're going to pay on it for 60 months. Yes, if I put it into a 30-year mortgage, is that extending out the payment on that? Yes. And I just got rid of your $700 monthly debt and turned it into $50 being added to your house payment.
Big deal.
Yeah. So, I mean, if you're looking at creating, the lowest monthly payment and monthly obligation total while allowing for cash flow on the backside, the debt consolidation refi makes a ton of sense. And the last one, the one that a lot of people are fond of right now due to the hardship, and it's not anything, it's something I'm glad we can help with, is the cash out refinance. So if you have, $150,000 you owe in your home and your house is worth $400,000, you may say, hey, Korbin, I know interest rates are low right now. I want to borrow money against my house at a low interest rate. Well, let me take $50,000 out and put it in where I can get it, where it's liquid, where it's not just equity in my house. I want to be able to touch it. So we would come in, pay off that $150,000 loan, add a $50,000 cash out to you to where you're getting that at closing from your attorney. And now you feel a lot more comfortable knowing that that's liquid for reserves during this, economic downturn, rather than just saying it's great to own your house. I think everybody, that's the American goal, American dream, is to own your home, and feel like you live a free life. But having $50,000 of equity in your home when you need $50,000 in cash is a tough situation to be in. I'd personally rather keep my money liquid, where I can touch it. And you can use that mortgage as a tax deduction in a year. So the cash out refinance is really popular right now, and something I do recommend to anybody who, wants a lower interest rate while rates are so good, and maybe also want some cash out to make sure they're not struggling during the time.
Awesome. So really, the three major refinances from what you're saying is the debt consolidation, the rate term, just saving money, plain Jane on your interest rate, and then the cash out option. When somebody's looking to refinance, do they really need to look at the interest rate, the time frame, or does it make most sense just to contact a trusted mortgage broker and ask through these things to figure out whether they should or not?
There's a lot of things you should look at. What's really important is actually looking at your APR as well as your rate, because a lot of people out there can easily say, oh, I can give you 3% on your rate, but they're charging you 2.5 points, which is going towards your closing costs and taking money, into your loan, basically charging you fees. And if you're just looking at rate and not looking at those fees, that can be really dangerous.
Okay.
So it is so important to, like we do business together, to get someone that you trust, get somebody you know is going to tell you when it makes sense, when it doesn't make sense. I pride myself on the fact that I'll be the first person to tell somebody, you're in a great rate right now. Whoever financed your loan the first time did a great job, gave you a great deal. There's no point in you refinancing right now. I think if you want to save money, in a different area, let me get you back in touch with Reid. This is where it makes the most sense, because there's a lot of lenders out there, or big box store lenders who have, people sitting in cubicles in Ohio or Illinois or somewhere like that, that'll say, yes, it absolutely makes sense, even if you're saving an 8% on rate. Well, we're not that company. I'm not that guy. Does it mean I don't make any money off of you? Absolutely. But it comes back around full circle. And one thing we pride ourselves on is if it does make sense, and it's going to make sense for you, I will give you all the options that make it advantageous for you. But if it doesn't make sense, I'll be the first person to say, Reid, thank you for the referral. Mr. and Mrs. Smith, allowing me to look at your portfolio, but right now you're in a great position and I don't see where I can help you in. And that's what we take a lot of pride on, is I think if it makes sense, it's a no-brainer. Right now, refinancing, if it makes sense, if it does what you want, what is your long-term goal, what is your short-term goal, and if we can achieve one of those, then yes, it makes sense. If it doesn't, then you're already in a good situation, and I'm not going to be charging you any fees for taking a look at it. We do, complimentary pre-quals, complimentary refi applications to see if it makes sense for you as a client.
Awesome, man. And you are moving right next door to me.
Yeah, I know. Reid is my new neighbor.
If you do some funky stuff, man, I'm coming over. I'm knocking on the door. And I'm really excited to bring to you today something called a Delaware Statutory Trust, a DST. Your real estate agents, a lot of them have never heard of this. Your investment advisors, your CPAs, your real estate attorneys, this needs to be known to people out there. A Delaware Statutory Trust. Korbin, you mentioned you do a lot of stuff with real estate you've never heard of.
Yeah, so I've been in the business now for 6 years, and when Reid called me one night, he said, hey, have you ever heard of a DST? And I said, brother, I've been doing this for a long time. I've never heard of it. I asked a couple of my realtors that I'm close with. They had never heard of it. And I told Reid, I said, you've got to get this out there so that you can build realtor partners and you can build rental companies that realize what kind of advantage this can bring to you. So I'm excited to, see what he's going to share with you guys today about the DST, because I had never personally even heard of it.
Awesome. And this is Berry Financial's not real estate agents. We're not realtors. We don't plan on being realtors. This actually helps realtors with a perfect client for the situation. And all a Delaware Statutory Trust is, it's a way to avoid capital gains. It works primarily with 1031 exchanges. So what's a 1031 exchange? Well, if you have a client that's got a $300,000 gain on a property and they want to sell it, they want to sell that property, you want to help them sell it. The realtor makes money, the client's happy, they're getting rid of the property. But now on that $300,000, let's say they've depreciated some of it, now they'll get a $150,000 capital gain tax bill, and the IRS may be coming looking for 30, 40, 50% of it.
And nobody wants to pay the IRS.
Nobody wants to pay the IRS, especially with all this stimulus money that I'm so glad people are getting. Tax rates are probably going to skyrocket in the next 10 to 20 years, no doubt about it. So now you got a client who's like, no, I don't really want to sell it because I don't want to get killed in taxes. Well, if they defer to do a 1031 exchange into a new property, they can avoid paying the capital gains tax, still maintain the property. So then that's a great thing about a 1031 exchange in general. Well, what if they do that, but they're saying, hey, I'm 65 years old. I want to avoid paying the taxes. I still want to maintain rental income, but I'm tired of being a landlord. The most beautiful thing about the Delaware Statutory Trust, quit being a landlord. What it basically is, it's a rental property, or it's a real estate fund, if you will, where you get to diversify your portfolio, right? Everyone likes diversification. You get to avoid paying the capital gains tax because you're 1031 exchanging into the Delaware Statutory Trust. The realtor gets to sell the property. The client gets to quit having the headaches of being a landlord and sell the property and capture those gains. They still get the rental income from the property, And yet they still get the step-up basis if they die at the time. Their children don't have to pay the taxes on that.
So basically, I can stop going to unplugged toilets, but still get my income.
Exactly. The terrible T's, right? The toilets, the termites, and the tenants. No, we want the terrific T's. The terrific, just different T words that are good. We want to do that. You still want to maintain real estate. So who is this for? It's somebody that's got a capital gains on investment property. They want to avoid paying taxes on the capital gains. They want to maintain their real estate. They want to, in their portfolio, they still want to get rental income. And another really cool thing, it's called, you don't have to put all the monies of the properties into a Delaware Statutory Trust. Perfect example. Let's say you got $1 million of capital gains, because you do have to be an accredited investor. Let's say you got $1 million of capital gains and you still want to control some, and you take $500,000 and buy your own property. You buy another rental property, you take $500,000, avoid the capital gains. You can take the other $500,000 and put it into this Delaware Statutory Trust. Well, let's just say, what's the alternative? You sell $1 million, you reinvest 500 of it.
Pay $500,000 on taxes.
Exactly. Now you got to pay taxes on $500,000. So let's say you net $350,000, and then you're going to put it in the bank and earning less than 1%.
Yeah. Versus diversifying your portfolio. Say I want to go buy a $500,000 property, but then invest the other $500,000 in a DST. Then I'm still making money off of all $500,000 of it at a much higher percentage than 1%, I'm assuming.
Exactly, 500,000 to 600,000%, because you're talking 5 to 6%. That's a big deal over 1%. You maintain real estate in your portfolio, you get higher income, and now let's say you roll that 500,000 to a DST, and then you die 6 months from now. Well, your children get to step up, and they get the 500,000. That's their cost basis. So you just received basically an extra $150,000 that you would have given to the IRS by putting it into a Delaware Statutory Trust. You have to be a licensed investment advisor representative to offer the Delaware Statutory Trust.
Which you guys are at Berry Financial, correct?
Exactly. So we've got our Series 65 license, which really what that means is to be fiduciaries, which just like you said, you are in the mortgage business. Our goal is to act the best, or act in your best interest, not ours, your best interest. So it's just a really cool strategy to be the well counters at Berry Financial with all your financial plannings, and to avoid capital gains on real estate. It makes perfect sense.
Absolutely. And I don't trust my money with just anybody. Anybody who knows me knows that. So the fact that I'm standing here with Reid, standing at Berry Financial, these are the guys that if you're a realtor, if you have a partnership that has a partner that has an investment, they think they want to sell that, and you want to sell that property for them as a realtor, get in touch with Reid. Reid, how can they get in touch with you to talk about that? Yeah,
I appreciate you asking that. So you can go to our website, berryfg.com. You can shoot us a call or give us a call at 843-808-9850. Different ways. We're on social media. We're on email threads. So really what I want to leave y'all with is, one, definitely with the mortgage rates. If you think you can save money on your mortgage, I've known you for a little while now. Yeah. It's coming up on a little while. You're moving next door to me, man. You've been awesome. We trust you, no doubt about it. So get in touch with Korbin Causey for your mortgages. If you've got people that are wanting to sell their property, but they don't want to get killed in taxes, then please let us know, because a Delaware Statutory Trust may be perfect.
Absolutely. We appreciate you guys being with us today. Once again, we're praying for everybody. We know the hardship that's going on. We've discussed, how this has affected our families, how this has affected our business. And we know there are a lot of small businesses out there that have been affected by it. So we're praying for everybody. Once again, if I can help you with your mortgage, if you think I can save you money, if you think your interest rate's too high, it probably is. And you can call me at 843-222-1109. And Reid and I are glad you watched this video and glad you were able to be with us today.
Hey, God bless y'all. Have a great weekend.